But if you tell a financial advisor that Bitcoin is volatile, they're like, duh. So they're not shocked by that. It's always these little nagging worries. It's the FUD things that we sort of make fun of on crypto Twitter. So like quantum is a thing. All it takes at an investment committee is one of the 8 people sitting there to say, yeah, but. And that has prevented most crypto allocations. The idea that we'll go from 7% of that market to 25% of that market in 10 years is not a crazy idea. That's actually a pretty easy argument. And then if you back out of that, what that means mathematically, it's $1.3 million. I think it could grow significantly more than that. I think it could easily take half the market, then it's 2.6. But you get to 1.3 with these very conservative assumptions. What's happened for the last 10 years will continue to happen. And as Bitcoin continues to mature, we'll go from 7% to 25. I don't think that's outlandish, and that's the number you get to.
Demographics are a straightforward yet potent factor in Bitcoin's long-term growth that is sometimes disregarded. Those who supported Bitcoin 10 years ago are now more than just early adopters. Many of them are currently employed by large organizations as portfolio managers, members of investment committees, financial consultants, and decision makers. This is how adoption really happens. Not all at once, but slowly, as early believers move into positions of influence, and then suddenly, when those institutions finally act on what they've learned. Now zooming out even further, Matt Hougan highlights a much bigger shift: tokenization. The idea is that traditional assets like stocks and bonds will eventually be represented and traded on blockchain networks. And this isn't just theory anymore. That's why many of the smartest investors aren't trying to guess a single winning coin or project. Instead, they're positioning themselves across the entire ecosystem because they believe this shift will reshape the entire financial system over time.
When you look at, okay, if these advisors are putting 2.5 to 5%, this thing's going to grow to 1.3 million. Do you also look at like what the other assets in their portfolio may do and kind of project out, okay, if Bitcoin's in your portfolio versus not, here's a general return profile that you should think about on a percentage basis?
Yeah, I mean, both backward looking and forward looking, it's just a massive increase in your absolute return and your Sharpe ratio. If you look at the average long-term capital market assumption for the next 10 years across Wall Street for equities, it's about 5%. For bonds, it's about 4%. For Bitcoin, we're calculating a 28% CAGR on those conservative assumptions. So it has a huge influence on your portfolio. And of course, it's asymmetric, right? You have a 2.5% downside. You have a doubling of your total return upside. I think it's a very convincing argument. Eventually, I think it will win. You're actually seeing it at the largest platforms. I know retail may be scared of it right now, but you're seeing these allocations at large $50, $100 billion platforms because they recognize that long-term trend.
What about public funds versus private funds, right? Obviously, the ETFs are the most successful product launch in history. I can imagine those conversations with getting onto certain platforms and being the kind of chosen or one of the chosen ETFs. It's a very different thing than, hey, give us your money and we're going to put it into a private fund or kind of an alpha-focused fund. How do you just navigate these conversations? And do you see, hey, I'm going to go and buy the ETF first and then people push into these other funds? Or do some people actually come in through the private funds and, eventually maybe trickle up to the ETFs?
Yeah, most people want the public ticker first, except for at the far end of the institutional spectrum. If you go to the far end of the institutional spectrum, they want a market-neutral hedge fund or a beta-neutral hedge fund that sort of captures some of the alpha in crypto. Everyone else is ticker first. The actual expansion is Bitcoin to Bitcoin, ETH, Solana, to index-based exposure, to, maybe I want an option overlay strategy in an SMA. That's sort of the direction of sophistication travel for financial advisors. Institutions still want the private exposure, by and large. Of course, there's some that own Bitcoin directly, but by and large, they still want that.
So that's interesting. They go from Bitcoin to Ethereum and Solana, not Bitcoin to, just give me the top 5, give me the top 10. It's kind of like single names until they then make the jump.
Yeah, try to explain Avalanche to an institutional investor. It has a very good story, but you need a long time, right? And they need to learn about it. It's similar to what we've seen in every market. This is actually no different. If you go back to the early days of emerging market investing, the only thing you could buy was large caps. And then EEM launched, and it was large and mid caps. And today, emerging markets is large, mid, and small caps. This is just the nature of how people invest. You're seeing it in AI. People want to own the hyperscalers and OpenAI. They're like a lot of really interesting AI companies. Eventually, people will migrate there. So yeah, they start at the top. They go to the top 3. Eventually, they'll get to index and broader exposure.
And what about miners, strategies of the world. Like there's other public tickers that now these advisors can go and look at. Do they just evaluate those on an individual equity basis, and they're more so comparing it to other single names they may own, or are they looking at that as substitute exposure to Bitcoin?
Yeah, I think many people, MicroStrategy specifically, think of it as a levered play on Bitcoin. We still hear that. I think on the miner space, people are most excited about the AI tilt. But we see a lot of interest in crypto equities. Our crypto equity ETF, BITQ, was up last year, and that caught a lot of attention. The average revenue growth for crypto equities is higher than almost any other industry in the market. That captures attention. But I think most of those people just buy an index basket. If you're deep into crypto, you probably want to own crypto directly. If you're more interested in crypto stocks, you probably don't have an opinion on this miner versus that miner. You just want sort of something that's related to crypto, and they go in through the index route.
Right now, the crypto market feels uncertain, prices aren't moving in a clear direction, volatility is still present, and many investors are wondering whether this is the start of something bigger or just another period of hesitation. But behind the noise, people like Matt Hougan are looking at the market very differently. Instead of focusing on short-term price action, he points to long-term structural trends, things like institutional adoption, growing demand for regulated crypto products, and the slow but steady entry of serious capital into the space. From that perspective, what looks like uncertainty on the surface may actually be early stage positioning beneath it. Let's explore the latest insights from Matt Hougan's recent interview.
You're telling me that advisors are still just as excited as they were, institutions are just excited. Tell me about the conversations you're having with a lot of these kind of more professional allocators right now.
Sure, yeah. I mean, I was in Miami last week. I met with about 50 advisors. They broke down into two camps. One had bought Bitcoin last year, and that camp was holding. They weren't buying more, but they were holding. The other hadn't bought Bitcoin yet, and that camp was licking its chops. We did this survey of advisors. We asked 400 of them that bought Bitcoin in 2025 if they plan to hold, increase, or decrease their exposure. 99% said they plan to hold or increase. Those numbers actually shouldn't be surprising because the people who bought ETFs in 2024 and 2025 stuck their neck out. It still wasn't popular. It wasn't mainstream. So the level of conviction was not 51%, Anthony. It was 80 or 90%. And so, the financial advisor, family office, and lower end of the institutional scale is diamond hands in Bitcoin right now, and I think that's going to continue in the future.
They went from a 0 to 1, right? They said, okay, we don't own any, now we own some. What were the allocation sizes? Are we talking like 1-2%, or are people going higher?
So it's in the advisor space, the right way to think, most of them are like 2.5, maybe 5%. But the more important statistic is it idiosyncratic or across their book? An advisor will have like 100 clients. What we saw a lot of people do was allocate for the 5 clients who were talking to them about Bitcoin, and then over time they expand that. So that's actually the bigger expansion than the percentage. The percentage has gone up. When Bitwise got into the market in 2017, advisors did 1% maybe. Now they do 2.5 to 5. But the bigger change, the thing that will re-accelerate flows, that I think will eventually drive Bitcoin flows to something like $50 billion a year, is people going from 2% of their book to 100% of their book. And we're seeing that in Bitwise at an increasing cadence.
Just like a model portfolio, every client gets whatever, 2.5-5% allocation.
Yeah, just slam it in there. Yeah, as a fixed percentage. We're seeing that, almost every week someone calls us up and wants to do that kind of thing.
Now, when you think about these folks going from I have no exposure to Bitcoin exposure, is it just Bitcoin? Is it Bitcoin plus some other cryptos? Like, how are they thinking about it? And I always go to, I've got 100 clients. I'm going to, on average, take, 20 grand out of their portfolio. I'm going to put it in. Does Bitcoin get all 20 grand, or does Bitcoin get, half, and then other cryptos get the other half?
Yeah, so historically, let's say for the first 18 months that ETFs were on the market, it was almost all Bitcoin. Advisors needed to go through the same journey everyone else in crypto does, which was learning about Bitcoin and then learning about other assets. I think going forward, it's going to be more diversified. We get an equal amount of questions about stablecoins and tokenization as we do about Bitcoin and debasement. So I think it may be like 50-50 Bitcoin and other assets. I think index funds will do very well. This is the marginal buyer of crypto. I think that's an important note. They're going to want diversified exposure. They're not as tribal as the OG retail investor, and I think that's going to change what attracts assets.
Now, what are the things that are keeping the folks who have not yet bought? Is it their clients are going to fire them? They don't understand it. They're scared. They just saw it drop 50%, and they're like, I can't put that in my portfolio.
Actually, the 50% drop doesn't bother them at all. I know that sounds weird being in crypto, but if you tell a financial advisor that Bitcoin is volatile, they're like, duh. So they're not shocked by that. It's always these little nagging worries. It's the FUD things that we sort of make fun of on crypto Twitter. So like quantum is a thing. All it takes at an investment committee is one of the 8 people sitting there to say, yeah, but. And that has prevented most crypto allocations. I think in 2024, there was no yeah, but. It was like BlackRock is buying it, Abu Dhabi is buying it, Harvard is buying it. It was easy to make the case. Quantum has actually entered the equation as a yeah, but. Doesn't matter if you think quantum is a present risk. It is the yeah, but in these investment committees. I think that's one of the things that's holding them back.
What do you guys say when they ask, hey, is quantum a risk, or how should we think about this?
Well, we walk through the logic of why it's an addressable risk, and we qualify the size of the risk that it is to Bitcoin, and I think that's helpful. But it's more important that Bitcoin core devs take steps to publicly address that. I actually think we saw that a little bit this week. I think this is now going to be a bullish catalyst moving the market forward.
How much does Fed policy, macroeconomics, all this stuff play into maybe not just the Bitcoin decision, but just the financial advisors in general, right? I can imagine some financial advisors probably love it, and it's kind of astrology for them to talk about. I think other people probably are like, hey, Peter Lynch said, spend 15 minutes on macro, you spent 13 minutes too long type thing.
Look, macro has become a much bigger part of every investor's view of the world since the COVID era. So it definitely comes up there. Terms that we didn't talk about 2 years ago, like debasement, like deficits, are now everyday discussions. So I think most advisors are now macro advisors. I think it was like a bad word pre-COVID. Now it's central to everyone's theme because it drives so much of the economy.
One of the pitches, I think, around Bitcoin used to be that it was a non-correlated asymmetric asset. And for those that didn't know that, that was like music to the ears of financial advisors and portfolio managers. Now there's a lot of talk that Bitcoin is actually correlated to software stocks or other types of assets in the market. What is going on there, and do the advisors care?
Yeah, those questions come up, but they're belied by the data. If you look at the correlation of Bitcoin to the S&P 500, which is the anchor of most people's portfolios, it's never been above 0.5 effectively since it started. 0.5 is the dividing line between low and medium correlation. It's still a diversifying asset. Has there been some correlation to software? Yes, I think that's idiosyncratic and not driven by fundamentals. But mostly, it's still thought of as a diversifier, right? The data just suggests that it is.
When you guys think of the long-term capital that can come in here, you guys published this paper. Talk a little bit as to what are the assumptions that you're making there, and then what would the impact be?
Sure. We published the first ever long-term capital market assumptions for Bitcoin. The most interesting thing about that is that no one asked us for that in the first 8 years of Bitwise's existence. And then last year, we had 12 multi-billion-dollar national firms ask us to publish that because that's what they use to decide to make their portfolio allocations. The number we came up with Bitcoin was $1.3 million by 2035. The way we get there is actually pretty simple. If you look at the historical growth of gold, not including this run-up, if you sort of average it out over the last 10 years, and you extrapolate that forward 10 years, and that's the store of value market, and then you assume Bitcoin takes 25% of that market, you end up at $1.3 million.
Well, so you're saying if you take the growth of the gold market, which historically operated without Bitcoin in the picture, you just say, okay, it's going to keep growing at the same rate it has been growing, and Bitcoin only gets 1/4 of all of that flow, then this is where you get the...
You get $1.3 million. The mistake people make when they make the gold analogy is that they forget that that market is growing, right? I came from the ETF industry. I remember when gold ETFs launched. The gold market was $2.5 trillion. It's $25 trillion today, right? That market is growing. And so the percentage that you have to take, the reason it's a powerful argument is in a world that's increasingly digital, in a world where crypto investors are getting older, wealthier, and control more money, the idea that we'll go from 7% of that market to 25% of that market in 10 years is not a crazy idea. That's actually a pretty easy argument. And then if you back out of that, what that means mathematically, it's $1.3 million. I think it could grow significantly more than that. I think it could easily take half the market, then it's 2.6. But you get to 1.3 with these very conservative assumptions. What's happened for the last 10 years will continue to happen. And as Bitcoin continues to mature, it will go from 7% to 25. I don't think that's outlandish. And that's the number you get to.
According to Matt Hougan, institutional change and demography are two of the most significant factors influencing Bitcoin's long-term growth that most people are unaware of. Those who supported Bitcoin 10 years ago are now more than just early adopters. Many of them are currently employed as executives, advisors, and portfolio managers at large financial organizations. They gradually include cryptocurrency and Bitcoin into the decision-making process as they advance into leadership positions. Because of this, adoption develops gradually inside the system before picking up speed when enough important individuals are in a position to take action. Additionally, he claims that because Bitcoin's projected long-term growth is greater than that of conventional assets like equities and bonds, it can have a significant effect on portfolios. Large financial platforms are already beginning to incorporate it because even a little allocation can increase total results. Hougan also highlights tokenization as a major future trend where assets like stocks and bonds could eventually move onto blockchain networks. Because of this, many investors prefer to gain exposure across the whole crypto ecosystem through major coins, infrastructure projects, and related companies rather than trying to choose a single winner.